In this video, we'll be talking about alternatives to direct real estate exposure, specifically about a hard money lending platform, PeerStreet. Previously, this was a very hard to access investment, but platforms like PeerStreet are making this asset investable to the masses. While overall a great platform, it does have some disadvantages. We'll go over those in today's video. If you like what you see, don't forget to like the video and subscribe to our channel. We'll have plenty more helpful information coming for the forward-thinking, non-accredited investor like you. So investing in real estate is very appealing for a lot of investors. However, it takes up a large chunk of capital. So in this review, we're going to be going over PeerStreet, which are hard money loans for your portfolio. PeerStreet, hard money loans for your portfolio. Start with a disclaimer. Please read the entire thing on our website. We'll start with a disclaimer. Please feel free to read this. It's available on our website. So hard money loans, what are these? So this is a way to borrow funds without going through traditional methods like a mortgage lender. So this happens when loans need to happen quickly or when traditional lenders will not approve a loan. So sometimes hard money lending may be the only option. Getting approved for a traditional loan or a traditional lender typically is a very painful process. So if these things need to happen very quickly, sometimes this is the only option. Hard money loans. So this is a way to borrow funds without going through traditional methods such as a mortgage lender or a bank. So getting approved for a traditional loan or via a traditional lender is typically a very painfully slow process, even if you have a great credit score and plenty of income. So if you have less than a great credit score or it needs to happen very quickly, sometimes these traditional lenders won't be fast enough to approve these loans. So hard money loans may be the only option at this point. Hard money lenders typically don't look at credit scores as much, but look at the underlying asset or the collateral and make and less about the borrower's ability to repay. So they're looking at the collateral and saying, yes, this loan makes sense. I think I'll do it because if the borrower defaults, I can just sell that collateral and recoup my investment. So one platform, PeerStreet, is attempting to bring this to the masses. So there's advantages and disadvantages. These are all new platforms, but we'll go through each of them and kind of explain a little bit more some of the risks. So the advantages are it's a very easy to use, intuitive platform. It does provide exposure to a previously hard to get asset class. You had to know somebody or be in the right place. Never really had these online platforms that were so easy to use and easy to invest. PeerStreet does have rather low minimums, so it's $1,000 minimum per note. So you can see with this, instead of buying one large hard money loan or investing in one hard money loan, you can invest in a number of different notes and spread out your risk across a number of different notes if people happen to default and you have to go through that process. You do have flexibility on the platform, so you can choose your individual loan investments or notes. You can invest in the entire thing, you can invest in partially via these notes, or you can set up automated investing and have your investments flow into different notes based on your specifications automatically, which is quite nice. With every advantage, there's a disadvantage. So with PeerStreet, the biggest one is that you have to be an accredited investor to use the platform. So unfortunately, it's not open to everybody, just the sophisticated, higher net worth investors that are determined to be accredited. There are liquidity concerns. So all of the notes are 6 to 24 months. They have a loan to value of 75%. But if you are wanting to exit that note before the end of the period, so say you invest in a 24-month period note and you are 12 months in, you need that cash. It's going to be pretty difficult to convert that into cash. It does have lower liquidity. So you'll probably need to hold that loan until maturity. I haven't done a lot of digging in, but I'm sure there's some way you can transfer that note, but you'll pay quite a big price for that. And finally, The returns might be as structured, might not be as tax optimized as they would be with a direct real estate investment. So it depends on the note that you invest in, but these returns are classified as all sorts of different income. So if it's classified as ordinary income, it's taxed as at your ordinary income rate. So the after-tax returns might not be as attractive as you thought when looking at the pre-tax rates. So key takeaways: direct investment in real estate offers a ton of tax advantages. However, it requires a lot of capital for the average investor and would represent a significant amount of their total asset allocation. So technology is always changing and evolving to help change this, giving investors access to these different asset classes with smaller amounts and giving alternative asset investors choices. So obviously these alternatives, these platforms are not quite battle tested. They don't have a track record in periods of significant downward market fluctuations, but they do offer exposure to a potentially new asset class that you haven't had access to previously. And finally, tax optimization is a concern, but you are able to structure these within a self-directed IRA. So you could structure them in a tax-advantaged account to have better after-tax returns. And lastly, as discussed, the liquidity concern. But if you plan on holding these until maturity, shouldn't be an issue.
If you like what you see, don't forget to like the video and subscribe to our channel. We'll have plenty more helpful information coming for the forward-thinking, non-accredited investor like you.